Today we're going to take a few moments and look at some of my favorite option indicators and see how what they're telling us about the stock market. We do a lot with options, of course, and you may or may not know our company, but there's three facets to our company. Our biggest part of our company now is devoted to money management. We're both a CTA and RIA, and we're currently managing about 85 million in option strategies through separately managed accounts. We started out as a derivatives research firm with newsletters and data, supplying data. We still do that business. That's on our website, and we also do a certain amount of option education, such as seminars like this, or we also have mentoring programs. Today's webinar, we will be emailing you the PDF of this webinar, so you don't really have to download it. But if you want to go to this URL, optionstrategist.com/novweb, there's some discounts on some of our products. All right, let's get started. So when I'm looking at the market, I look at four main things, although we're going to be delving into a few extra things as well today. But the first and foremost is the chart of the S&P 500, because if the S&P 500 chart is bullish and you have bearish indicators, you have a problem. So it's really the most important thing is the chart of the index itself or the chart of the market. But we look at also equity only put call ratios, very useful contrary option indicator. We look at market breadth, and we have a slight option twist to that. And then we look at the volatility indices, primarily VIX, but others as well. So when we're going through this, you're going to see that, as you might expect, with a market that's up this much and this rapidly, that a lot of the indicators are overbought. We saw the same thing in periods in the past, for example, in 2003 to 2015. But overbought does not mean sell. We have very strict rules about what's a sell signal and what isn't. And so we don't, just because something is overbought, it actually could be roaring to the upside at that point. So we will not consider that a sell signal until we actually had something confirmed. On the downside, oversold does not mean buy either. So we're not going to see any oversold indicators today, but we do sometimes when the market backs off, and it's the same thing there. In the 2008 crisis, for example, if you'd have bought the first time things got oversold, you'd have been overrun. So you really have to wait for confirmed signals. So here's the current chart of the S&P 500. There's not a whole lot of fancy things on this chart, but this current rally that we're in, I mean, the big rally that we're in started in 2009, but the current rally that we're in started with the U.S. election back here in November last year. And it's had a couple of pauses along the way, which establishes support and resistance areas, mostly support areas. But now we had this latest breakout in September, really right here to a new high. And since then, we've really been off to the races, making a whole series of new all-time highs with almost all the major indices. And that has left support, very strong support at 2480, which was the level we broke out above in September. And then we also had a little pullback at 2510, so that's another little support area there. So those are the two ones that I view as near-term most important support. If the 2510 area were to be taken out and the 2580 were to be taken out, then this chart would really no longer be bullish, in my opinion. You'd have to be playing strong defense. Now, the other lines, the other horizontal lines on the chart, were other times when support and resistance was set up along the way. And you can see there's quite a bit as you fall down. But if we were to fall below 2480, I think that would scare enough people that you have a pretty major problem on your hands for a while anyways. So just to summarize that, we've broken out the new highs, and that confirms the breakout. The other indices are also breaking out: NASDAQ Composite, NASDAQ 100, which is this one, the Dow, the mid-cap 400, the New York Stock Exchange. The one thing that's been lacking is the Russell. It's not really been selling off a lot, but it just has not made new highs for about a month. So that's a small nagging negative divergence, but nothing major yet at this point. As I said, there's support at 25.10 and 25.40, and we would consider that to be quite important. Even though there is support below that, I do think psychologically the break of that 24.80 level would be enough to cause some problems for most traders and probably generate a heavy bout of selling. The really important level is 2400, but that's so far from here that, you know, if you waited till then to turn bearish, that would be way too late. Right now, the trend lines are all positive on the S&P 500 chart. By that, I mean like the 20-day, the 50-day, the 200-day. And also, we're going to look at something in just a second to do with Bollinger Bands. But these things are all positive, pointing higher. And so the outlook for this indicator, strictly the S&P 500 chart, is that it's bullish. I mean, there's really no way you can say that chart is bearish. So we're noting that, and as I said before, that's one of the most important indicators, actually the most important indicator. So that we would not really turn significantly bearish on the market until some of those support levels were broken. Now, the first overbought condition I want to bring to your attention is what I call the modified Bollinger Band condition, and it has just issued a sell signal. Bollinger Bands, as I'm sure you know, let me just show you a chart here. Bollinger Bands surround the 20-day moving average of any chart, in this case the S&P 500 index. When John Bollinger invented Bollinger Bands, he defined volatility as the standard deviation of closing prices, which certainly seems logical, and I think a lot of people would say that is volatility, but it really is not the way the mathematicians do it. Now, Black-Scholes, for example, uses volatility as being the standard deviation of percentage daily price changes. And that's the definition that most mathematicians use, and since Black-Scholes uses it, that's what's used to determine applied volatility of options. Since we're option trader and option research firm, we have to agree with Black-Scholes or we'd never get anywhere. So we use that definition of volatility. So I've modified the Bollinger Band calculation to use that definition of volatility. And the way these Bollinger Band signals work, let's just take one here, for example. I'm trying to locate my, here we go. Let's just say this one right here is pretty easy to see. So you can see the index broke down here below the lower band. This lower band is -4 standard deviations, and the next one inside it is -3 standard deviations. So it has to close below the lower band and then close back above the -3, and that was a buy signal right there. You can see we had several of these along the way. There's another one there. So the buy signals on this chart were all quite successful. The sell signals, maybe not quite so much so. This is kind of a false sell signal followed by a good one. The way I usually do on my charts is a red letter means that was a successful signal. This sell signal here, I don't know, and the market just went sideways for a little while. So here's the current situation. This is the chart over the last year or so. And you can see we did get a Bollinger Band buy signal in November. We haven't had one since. The market has not sold off enough since then to ever go below the -4 standard deviation band. But it has risen above the other one a couple of times. So that was that same sell signal at the end of the last chart. And all we got out of that one was about 6 weeks of flat action. The one that occurred at the beginning of March, we got about 6 weeks of modestly downward action. And now we've just got another sell signal. We were above the 4 standard deviation band for 14 days, which is actually quite a long time. I'm not saying that that really means much of anything, but it just is a long time to be that overbought. And now we closed below the 3 standard deviation band last weekend. That gives us a sell signal. So far, you know, there hasn't been much selling, but you know, we could be in one of these periods where we just go sideways for 6 weeks, but I do think the momentum is coming out of this market because of this sell signal. Just one other sort of interesting thing on this chart, it went above the 20-day moving average right there in early September and never touched it again until last week. So was above the 20-day moving average for like 36 trading days or something like that. Quite a long time, and another indication that the market was getting quite overbought, and still is rather overbought. So so that's just an aside. We'll review that again later, but we do have a sell signal from a fairly trustworthy indicator. The long-term track record of that modified Bollinger Band signals is quite good. So the second major indicator that I look at is put-call ratios, and specifically for predicting the broad market, we look at equity-only put-call ratios. In other words, all stock options that trade. No index options or futures options go into that calculation. And the theory, it's a contrary theory. So if too many people are buying puts, then that means we should be thinking something bullish. And if too many people are buying calls, everybody's piling in on the long side, we should be thinking about doing something bearish. So the put-call ratio was invented by Marty Zweig back in the 1950s, and he just used simple volume. So let's say take IBM, and we sum up, at the end of the day, we sum up the volume and all the puts that traded in IBM. Separately, we sum up the volume on all the calls that traded and divide the two, and that's the put-call ratio. Why he didn't use calls over puts, I don't know, but this is the way he did it, and it stayed that way pretty much ever since. So since put buying is in the numerator of this fraction, in a heavy bear market where a lot of put buying is going on, the ratio will go higher. And since call buying is in the denominator, in a bull market, heavy call buying takes place, and the denominator expands, and so the ratio would go lower. So basically, the ratio is moving inversely to the underlying stock. We keep a moving average. I use 21 days just in case there's something into Fibonacci, but you do need to use some moving average, some smoothing technique, because the numbers are quite wild on a daily basis. So this is, in theory, the way it goes. The put-call ratio reaches a low when everybody's buying calls, and finally the call buyers have exhausted themselves, and that's the time that you want to sell the stock. When the put-call ratio forms a local minimum on the chart and begins to rise, that's a sell signal. So now during the next phase, people are buying puts, and during the phase, the public is right, so they're buying puts and the stock is dropping. But eventually, there's just too many put buyers, and they've exhausted themselves, and the put-call ratio rolls over and starts to head downwards, and when it rolls over, that's a buy signal again for the underlying stock. Here's not a recent, but just a chart of the equity-only put-call ratio on the bottom and the S&P 500 index on the top. And I just want to show you the inverse symmetry that exists between the two, so that you can see that using this put-call ratio to help predict where the S&P 500 is going is a worthwhile endeavor. So here's the current put-call ratio, the equity only. This is the one that we just decided just described. It uses the volume of the options, and you can see that there was a local maximum back here in late August, early September. So that gave us a buy signal about right in here. The buy means buy the index, and now we've been moving higher ever since. And this thing moved lower, kind of flattened out there in October, and now it's started to move higher. So we got a sell signal in early October, and it really hasn't panned out to be much of anything yet. But on the other hand, it's still in force. The ratio is still moving higher. In fact, it was last night, it was even a little bit higher like that. So we're waiting for this thing to move up, and eventually someday we'll roll over and give a buy signal. Well, right now it's on a sell signal, and while that might look like a little bit of a wishy-washy sell signal, we do use a computer analysis program on these charts. The computer can tell what numbers are coming off from 21 days ago. It can tell what numbers are likely to be coming on, because the put-call ratio tends to be in the same neighborhood from day to day, even though it's not the same number. And therefore, the computer can project ahead a number of days, 10 days in this case, to see if the thing is likely to roll over. And it's telling us right now that it's not. So the computer is confirming that sell signal. Now, since the computer came along, we can do a little more sophisticated attempt at this. And we can measure the dollars being spent on calls versus the dollars being spent on puts, and that gives us a better, I think, a better picture than just the ratio itself. So every day at the end of the day, again, let's say it's IBM, we take the option closing price or average of the bid and ask, whatever you want to use, times the option volume that day. Now you could, if you really wanted to get into that, do that calculation for every trade that takes place. We just do it at the end of the day, save a little computer power. And so you make that dollar volume calculation for every option. Then you sum up those for all the puts. Separately, you sum up the dollar volumes of all the calls, and you divide the two, and it's your weighted put call ratio. So now we're measuring the dollars being spent on bullish opinion versus the dollars being spent on bearish opinion, and that's a more reliable thing in my way of thinking. So here's the equity only weighted. So on our charts, and by the way, on the area of our website that we post these charts called the strategy zone, we post about 400 charts every day, futures, stocks, indices, these, and a number of other things. So first of all, this chart's not quite so busy. You can see the buy and sell signals are a little bit more spread apart. And in fact, at the current situation, this came up and gave that rolled over local maximum, giving us a buy signal here somewhere around the early September. This ratio has continued to just fall and fall and fall. It had that little bit of a wiggle there, but still falling. And it now has reached a level that it hasn't seen. It's even below where it was there in July. It hasn't seen these levels since late 2013. Now you may think, well, that's not that long ago. But the fact is that the put call ratios really since 1987 have slowly been rising because more and more people are understanding the value of buying puts as protection for your portfolio. So the general ratio has been moving higher over time. So for this to be as low as it was 4 years ago or 3.5 years ago, almost 4 years ago, is very significant, and it indicates how overbought we are and how much call buying has been going on. Now I have a sell signal here because that's what the computer says. The computer says this thing is going to reverse and start to go upwards, and that would be your sell signal. But I like to do, have at least a little bit pleasing to the naked eye that I would want to see at least curve upwards a little bit like that. So right now, while the computer is saying, it can't stay this low for this long, that's more of a kind of a statement based on averages. I'd really rather like to see it move higher visibly like that. But in any case, it's very low, very overbought, and according to the computer, on a sell signal. So just to summarize, both these ratios, the first one I call the standard, where we just use the volume, standard equity only put call ratio, and the weighted both gave buy signals around September 1st. They're both overbought since they move much lower, especially the weighted. And as I said, the computer analysis has given them both sell signals because it's taking into account what's coming off the 21-day moving average. But I think, from experience, I'd like to see them move higher. So I'm just calling them extremely overbought, but especially that weighted ratio is not yet visibly on a sell signal. While we're on the subject, I'm going to show you just some individual stock and futures put call ratio charts that usually we trade off of these in our daily strategist and options strategist newsletters. We have pretty good success. And what I like to see on these is what I like to use is just a real extreme signal. So here, there was a local maximum there, an Apple local minimum there, local minimum there, but none of those were extreme. The extremes are down here, way down here where the ratio got a few times, and then way up here. So this was a local maximum. It's a buy signal, and you can see that was a tremendous buy signal. So we rode that thing up quite a ways. It actually gave a sell signal here, but when we're on a successful signal and we're running it with a trailing stop, I will not take the intervening signal. So we're on a successful buy signal. We did not actually take that sell signal. I would have, if I had broken a support area there, but it didn't. So we eventually got stopped out later. This sell signal we did take when it broke support right there. It was very short-lived, didn't do too much. Another buy signal. And then most recently, we did have a sell signal in early September. And if you recall, Apple did back off, but then it began to slightly move higher, and we got a local maximum here. Now, I said we don't use the local maximums as signals to get into a trade, but to get out of a trade we do. So that was our point to cover that short sale. Here's AstraZeneca. This one has been a good trade for us a couple of times. Most recently, we had a double buy signal. First one wasn't so good, but the second one was good. And it took a little while to develop, but this thing has been moving nicely higher. And so we're running a trailing stop on that right now. So even though it rolled over and gave this local minimum, which would have been a sell signal, we did not heed that. We're running a trailing stop on the most recent buy signal. Applied Materials, this one had a great buy signal. This was a very high ratio for this stock. You can see that was the highest on the chart, and that local maximum gave us a buy signal right there, which we're still in, and that thing is roaring away to the upside. British Petroleum, just recently, last week in fact, gave a sell signal, a local minimum on the chart. And so that's a sell signal. And the only thing we had to really compare it with was one other sell signal here back in January, and that was a pretty good one. The stock backed off some after that. So we're hoping for a similar result this time. Freeport McMillan, quite a few of these are, I guess, related to commodities. This had a couple of nice signals, although the last one was not. But we had a good buy signal here in last spring, and then gave a sell signal in September. I wouldn't say it's been terrible, but it hasn't made any money. It's just kind of sideways from where we've been in it. So I believe we were out of that when we bought options, and they essentially expired, and so we let that go. By the way, since these are relatively long-term in option terms signals, they last 3 to 6, 9 months even. We buy an at-the-money option. It seems to be a pretty good balance there between the risk of owning an at-the-money option, but the potential that you can make quite a bit of money because you're going to be holding it for a long time. So I don't want to buy too deep in the money, because I'm going to hold these until the put call ratio rolls over, no matter what the underlying is doing, pretty much. So that I can do more comfortably with an at-the-money option. And basically, I don't really buy out of the money options, period. So that's not really a factor here, unless there was something I was really expecting, like a takeover or something like that. FedEx, that's been a good one several times. We had a good buy signal here, local maximum, then moved higher. Then it rolled over and gave the sell here. And at first we were just running a trailing stop, but then it actually stopped us out right there, fell below the trailing stop, so we were out. Here's gold futures. This one gave a sell signal in mid-September from a very low level on the chart, and can't quite see it up here. The last time it gave a sell signal from that depth, the gold did fall for quite a while. This time it's fallen some, but it's just kind of meandering there right now. So we rolled up first set of puts down, took a profit on it, and we're holding a second set right now. And then lean hog futures have had a couple of decent sell signals along the way. So those are some individual charts. We make, as I said, we make recommendations based on those weekly in our research newsletters. So, but to summarize, this is one other ratio, I'm sorry. This is the total put call ratio. So in this one, we do bring the index options in. So here we look at index and...
Well, why not, just in case we run out of time, and then you can finish your halfway.
I'm not sure, was that someone talking to me, or was that just an accidental recording? Anyways, the total put call ratio gave a buy signal on September 5th, there's a little typo. And when this powerful ratio gives a buy signal, it calls for a 100-point rise in SPX, and that took place by October 23rd. So we're still in some of that position, but we took partial profits and we rolled up. Now that one I did buy out of the money because we had a specific target 100 points higher. So we did buy out of money options for that one. Market breadth is the third thing we look at. Breadth is simply advances minus declines. We keep a cumulative total of that. And the cumulative advance decline line sometimes can deviate between what's the standard New York Stock Exchange advance decline line. This is, you can see here at this period of time, that was going higher. But if we looked at just the advance decline line using all optionable stocks, which doesn't include all the weird things that are on the New York Stock Exchange, you can see that was going lower. So they can differentiate, deviate. And we also keep some oscillators where our oscillators 90% of yesterday's value plus 10% of the difference between today's advances and declines. That would be, if you want to get started on that, just shoot me an email and I'll send you the starting value. But here's the way the oscillator looks at it. When it gets overbought, again, it's not a sell signal till it stops being overbought. So we just had a sell signal on this the other day. And so the breadth indicators are now in sell signals as well. So we usually like to see some confirmation of these breadth signals, but we are starting to get them from put call ratios and a couple of other things. VIX is the fourth thing we look at, the volatility of the market. The trend of VIX is very important, and it should be trending opposite to the market's direction. And secondly, spike peaks in VIX are buy signals for the market. So when VIX is very low, as it has been now, again, that's an overbought condition, but again, not a sell signal. Wouldn't be a sell signal until VIX begins to rise and trend higher. Now, we've had a couple of upward probes in VIX. This is the chart of VIX over the last year. First, let's talk about this buy signal. So a spike in VIX upwards and then back down again is a buy signal for the stock market. So that's happened 5 times in the last year. This one was a losing signal, although it was quickly followed by a winning signal. That was a very good winning signal there. The one from the election, that was giving you a buy signal right on the election. Then we had another buy signal in May. And then these two were right together. You wouldn't probably take them both, you just take the first one. Again, it was a good buy signal in August. Now you can see that VIX has pretty much not been able to penetrate through this 16.5 area or so this year. But if we waited till VIX got about 16.5 to turn bearish, again, that would be, I think, too late. So many other times it's topped out near the 13 level and unable to close above the 13 level many times again last week. So for me right now, if VIX were to go above 13, I'd start to get a little nervous and probably lighten up on longs and start adding to shorts. So the current VIX state is, not a problem for stocks for VIX to be low. It's been low for a long time. Stocks have been going higher, but if it gets above 13, closes above 13, and it's trending upwards, then I would start to get a little bit worried. But even then, as you saw from the last chart, 16 level is really the important level as far as VIX is concerned right now. But at the current time, with VIX down here below 13, it's still a bullish indicator for stocks. And it's been surprisingly bullish. And as you know, there's no fear, blah, blah, blah in the market. But, there will be. It's just not right now. So Keynes said the market can remain irrational for as long as longer than you can remain solvent. I'm saying VIX can remain low for longer than you can afford to keep losing money buying protection. A lot of people keep trying to buy the VIX and it's just not working out for them. If you're going to buy VIX for protection, stay short term and stay well out of the money. Just use it for disaster protection. Now, I wanted to just finish up with a couple more points here. One is the construct of the VIX futures. This is composed of 2 things: the premium level on the VIX futures and the slope of the term structure. We'll look at both of those. But basically, if the futures are trading at a premium, which they are right now, and if the term structure slopes upwards, that's bullish for the stock market. And if the opposite occurs, that's bearish for stocks. So here's the current status of VIX and the VIX futures as of last night's close. This closed at 1050. The futures closed at these various prices. And the premium is just this number, 1158 minus VIX of 1050 equals 108. So you can see all the futures are trading at a premium to VIX. So that's bullish. And of course, that's what you'd expect with VIX being this low. Moreover, you can see that each futures contract is trading at a higher price as you go out in time than its predecessor. So that's an upward sloping term structure, and that's bullish as well. And you might be thinking to yourself, well, wait a minute, I heard on TV it's bearish. Well, I'll show you in a minute. But right now, just take my word for it, that's bullish. If you don't have access to the futures prices, although they are available for free on a closing, a 20-minute delay at the CBOE's future exchange website, you could just look at the CBOE futures in CBOE volatility indices that are published. There's VIX, the one you're probably most familiar with. That's a 30-day index. There's also a 9-day index. There's a 93-day index, which just recently changed its symbol from VXV to this thing. And then there's a 184-day intermediate term index. And you can see, again, the longer term ones are trading at higher prices than the lower term ones, so that shorter term one. So that's a upward sloping term structure, and that is bullish. The upward slope is bullish. So let's go back to the other question. Why does the term structure slope upwards in a bull market? A lot of times you'll see guys on TV. I'm just going to back up a couple of charts and they'll say, oh, well, look, out here in May, the futures traders are saying VIX is going to be 16 in May. And VIX is going to, that means the VIX is going to move from 10 where it is now to 16 in May. The market is going to have to go down for that to happen, and therefore that's bearish. All of that I just said is completely false. And you will hear that on TV and many of the option stuff, many of the option shows or whatever, but it's completely wrong. What's more likely to happen is that 1650 will just come down to meet VIX, because the futures have to be trading at the same price as VIX at expiration. Let's just see why this is true. Suppose you're a market maker, pretend you're a market maker here, and say some guy comes in, he wants to buy a 1-week call on the index. Well, right now VIX we saw is trading at 1050, so you might charge him something a little bit higher. Let's say it's a 1-month call, so you charge him maybe 13 vol for that call. I'm not talking about the price, we're talking about the implied volatility. But then somebody comes in and says, well, wait a minute, I want to buy a 3-year call. Well, now we don't have any idea, no one does, where volatility is going to be in 3 years. So what the market maker will generally do is he'll take maybe the average volatility for, the index is 20 or 21 over the long term. He's going to price this at 25 to make you pay up a little bit for the call, as would be expected. And so now we have a 1-month call is priced with a 13 vol, and a 3-year call is priced with a 25 vol. And that's because vol is low right now. The 13 is near 10, which is where it is now. Now suppose somebody comes in and says, well, I want to buy a 2-month call. All right, well, that's not going to be much more expensive than the 1 month, but a little bit, because there's more uncertainty involved, and volatility is very low right now. So we'll price that at 15. Then somebody else comes in and says, well, look, I want to buy a 2-year call. Well, that I'm not giving you much of a break at all on the long-term one, because again, who knows where volatility is going to be in 3 years, but I give you a little break, so we'll price that at 23, 24. And then something in between, an 8-month call, maybe prices at an 18 vol, and a 17-month call prices at a 21. And so the term structure ends up sloping upwards like this. And the only thing that's determining that is volatility is very low right now, 10.5, and average volatility is much higher. And so as you go longer term, there's less certainty, and the vol will tend to trend more towards the average. And that's the only reason the term structure slopes upwards. But it's bullish for stocks because we're already in a low state, and as long as it stays here, the market can easily move higher. Now, if it inverts, I don't have that chart, and things start to get nasty, then VIX could shoot up to 40, and I'm going to be charging prices like these for the calls, and then the term structure would slope downwards in a bear market, and when VIX is 40. So just returning to the overall picture, the VIX futures construct is bullish. The CBOE construct is bullish. The term structure is sloping upwards. VIX is trendless, so that's bullish. So overall, this is bullish. So our status of the entire broad market is, as of today, is that we saw the S&P 500 as bullish. The put-call ratios are overbought, and the computer's rating them as a sell. Breadth, we do have sell signals, but VIX is bullish. The term structure is bullish. So basically, we're staying intermediate term long with a stop below 25.10, that first support level. Now, what about you know, a couple of those other things? Well, let's look at those. Well, one other thing first. We do have a way of looking for a sell signal when VIX gets extremely overbought. VIX actually is in its third iteration. It was invented in 1993, and for 10 years it stayed the same. It was using OEX options in its calculation, and that old version of VIX can still be quoted as VXO. Then for the next 10 years, actually 11 years, VIX used monthly options, MO, and two strips of options 30 days apart. Again, both of these were 30-day volatility indices, which is what VIX always has been and probably always will be. But now instead of using OEX options, we're using SPX options, and we're using a lot more of them. And then finally, after a lot of the weeklies came in and the end of the quarter or whatever, they changed the VIX calculation once again, and that's the current version of VIX. And it uses the two strips of options out here that most closely surround 30 days in the future from today. So when we first observed this, there were only two indices, and we noticed that if VXO closed below 10 and the second version, VIX-MO, closed below 10.5, that was an immediate sell signal back in 2006, and it led to a very good trade in 2007 when SPX was down 50. This is a short-term thing. It doesn't change the major trend in the market. Obviously, the market didn't top out that year till October 2007, but it was a good short-term trade. Since then, it hasn't reoccurred until this year. And this year, we've had repeated times when VXO closed below 10 and VIX-MO closed below 10.5. So we changed our thinking on this. We're looking at it as a very overbought condition, but we're going to wait for one of those two to rise before we actually call it a sell signal. And in fact, that one did. VIX-MO rose up above 1080 in last week and gave a sell signal. So this is the actual fifth signal in 2017. 3 of the previous 4 have sort of stalled the market, but not reversed it. Here's a chart. Now, this chart's a little bit busier. These red and blue S's are from the modified Bollinger Bands. I just want to see how this relates to them. But since through the summer, we had a series of these sell signals, and one was a little sharp decline. This one, nothing. This one, a slow decline. This one in August, a little bit more of a decline. And now we just got another one here to go along with the modified Bollinger Band sell signal. So those two things have both come in together in the last week or so, and I do expect that that will be enough to stall this market out. Now, so we have this modified Bollinger Band sell signal. We have breadth oscillators on sell signals. We have the put call ratios on sell signals according to the computer, and they'll probably, first little pullback in the market, they'll go to sell signals. We have this one I just explained, the VIX-MO sell signal. So is this significant? I mean, is this enough to turn the market? Actually, no. As I said in the beginning, the S&P 500 chart is the most important thing, and volatility is very important as well. So until the S&P 500 chart breaks support and VIX breaks out above 13 and begins to trend higher, the best we're going to get out of all these sell signals is a short-term correction. And I do think we are going to have that short-term correction right now, and I would not expect to see much of a price advance over the next 6 weeks. In fact, I'd expect to see some pullback. But as long as the S&P 500 chart doesn't break any significant support levels, then our intermediate term outlook will remain bullish. Okay, as I said before, you can go to this website for some discounts on our products. We will be sending you an email with the information about this webinar, including the PDF, and I believe it's being recorded, so you'll be able to get the recording as well. There's my contact information if you want to shoot anything over to me, and that is not a good URL. McMillanasset.com is for our money management. So if you're interested in money management, McMillanasset.com will work, but the NoveWeb portion will not work with that one. If you'll, I'm just going to back up one slide. You'll see it's optionstrategist.com, which has the NoveWeb URL. All right, I don't know if we have any questions here. If so, I could never really know where to look for questions on these things. Let's see, let me try something that says questions. Okay, I'm seeing there's some stuff there. Okay. Okay, we're going to upload the video. That will be, you'll get an email on that, I think, from Investor Inspiration. Let's see. Okay. The indicators become more accurate if combined to confirm each other. Well, as I said, I think they do to a certain extent, but the S&P 500 is most important. I don't know what that means. Like saying an option is implying a price in the future. Well, options in the future do not imply prices. They might imply a volatility estimate, but even then, it's kind of weak. Do you have an example of a term structure of VIX that is bearish white? I think I did show you that, where it slopes downwards, and somebody's learning the fancy language, contango. It's a cool word, but most people can't remember what it means. Contango is where the near-term futures trade at a higher price than the longer-term one, so that would be this slope. That's bearish for the term structure, and non-contango is that's bullish.